Corruption Exposed, Episode 1, Part 3. The One Big Beautiful Bill, the fallout they didn't mention in Part 2. We dissected what was actually inside the so-called Tax Cuts and Jobs Act of 2017. We exposed how the bill permanently slashed the corporate tax rate, handed massive windfalls to pass-through entities and billionaires, doubled the estate tax exemption, and weakened the alternative minimum tax. Meanwhile, individual cuts were temporary, and most of the law's supposed middle-class relief was more illusion than reality. We showed how the benefits were stacked in favor of corporations and the ultra-wealthy, while the bill's true cost was hidden under patriotic language and strategic spin. Now, in Part 3, we examine what came next. By the time President Trump signed the Tax Cuts and Jobs Act into law, the headlines had already done their job. It was being framed as a victory, not just for his administration, but for the American people. A historic tax cut. A once-in-a-generation overhaul. But while the cameras turned to the next controversy, the real consequences were just beginning. In this episode, we examine the fallout. Not just what was promised, but what actually happened. Who benefited? Who paid? And how this bill continues to shape the American economy and our national debt to this day. Let's start with corporate behavior. The law slashed the corporate tax rate from 35% to 21%. That was supposed to create jobs, raise wages, and bring offshore cash back to the U.S. economy. Lawmakers argued that if companies had more money, they'd reinvest it in their workers. That didn't happen. In 2018 alone, American corporations spent over $1 trillion buying back their own stock, a move that inflates share prices and benefits shareholders, not employees. According to SEC filings, some of the largest beneficiaries of those buybacks were executives, who were compensated with stock options tied to share price performance. Wages? They rose slightly, but not nearly at the rate promised. A 2019 study from the National Bureau of Economic Research found that there was no statistically significant increase in worker compensation as a result of the tax cuts. In fact, when adjusted for inflation, real wage growth stagnated for most middle-income workers during the first 2 years of the law's implementation. Meanwhile, companies like Amazon, Delta, and General Motors paid $0 in federal income taxes in 2018. Some even received refunds, despite earning billions in profit. So much for the argument that tax cuts would lead to greater fairness or broader prosperity. And then there's the national debt. Before the TCJA, the federal deficit was already growing, but this bill put it into overdrive. According to the Congressional Budget Office, the law added nearly $2 trillion to the national debt over 10 years. And because the corporate cuts were permanent, those revenue losses are now baked into the system. Supporters claimed economic growth would cover the difference. But growth only briefly spiked, and quickly leveled off. By 2020, the U.S. economy was slowing again. And then the pandemic hit, exposing how fragile that growth really was. To make up for the lost revenue, lawmakers didn't reverse the cuts. They didn't raise taxes on corporations. Instead, they targeted spending, proposing reductions in Medicare, Medicaid, SNAP, and other public programs. In short, the government gave billions to corporations, and then looked to cut services for the public to balance the books. Let's talk about inequality. The richest Americans saw dramatic gains from the TCJA. A 2020 analysis by the Institute on Taxation and Economic Policy found that the top 1% of earners received an average tax cut of over $50,000 per year under the law. Compare that to the bottom 60% of earners, who saw annual savings of less than $500, and in many cases, those savings were completely offset by higher healthcare premiums or the expiration of deductions. In fact, some middle-income families actually saw their tax burden increase due to the elimination or capping of deductions, like SALT, mortgage interest, and personal exemptions. And remember, the individual tax cuts expire in 2025. Unless Congress acts, millions of Americans will see their taxes rise, while corporate rates stay low indefinitely. Now let's talk about state and local impacts. With fewer federal dollars available, states were forced to rethink their own tax codes and spending. Some states mirrored federal cuts, fearing competition for businesses. Others raised local taxes or cut programs to offset shortfalls. This created a patchwork of unequal impacts, where low-income communities were hit hardest. And while big businesses prospered, small businesses struggled to navigate the complex pass-through deduction rules, many lacking the accountants or legal support to take full advantage. It's also worth noting how this bill shaped the political landscape. The TCJA was passed without a single Democratic vote. It was a purely partisan bill, written behind closed doors, rushed through without public hearings, and passed under reconciliation to avoid a filibuster. It widened the partisan divide and deepened public mistrust. For many Americans, the bill became a symbol of what's broken in Washington: powerful interests writing legislation, lawmakers selling it with hollow promises, and the public left to sort through the aftermath. And that aftermath is still unfolding. By 2025, unless major revisions are made, the law will allow corporate tax cuts to remain untouched, cause individual tax rates to rise, increase the deficit, and further entrench wealth inequality. Some lawmakers are now proposing extensions of the individual cuts, but without raising corporate taxes, that would only worsen the deficit. Others are calling for a full repeal or overhaul. But with lobbyists entrenched and corporate interests funding campaigns, that fight is uphill and ongoing. So what does this all mean? It means the Tax Cuts and Jobs Act wasn't just a piece of legislation. It was a reshaping of the economy in favor of the powerful, marketed as a gift to the average American. It was an experiment in top-down economics, one that failed to deliver for most of the public, while rewarding those who needed help the least. In Part 4, we'll break down the role of the lobbyists, the people and organizations who helped craft this bill behind the scenes, and how they shaped the outcome to their advantage, often without a single vote from the public.